It just keeps getting bigger. Debt, which was dirt cheap in the zero interest rate environment for nearly a decade, has been funding corporate spending, mergers and acquisitions, share buybacks, cash burn, and other noble corporate activities. Netflix, Tesla, Verizon, Apple, they all have been borrowing vast amounts, and this pile of debt is still growing. Now, interest rates are rising. Some of this debt is fixed rate debt, and the interest expense that the company pays remains the same until the debt matures, at which point it has to be refinanced at a higher rate. But other debts have a variable interest rate, and that debt is becoming more expensive on a monthly basis. Apple isn't going to have a huge problem with this, but other companies will. The path to a somewhat quote-unquote normalized interest rate environment after a decade of central bank emergency measures and credit market manipulations is not going to be pretty. And in some areas, a credit bloodbath has been scheduled. But will it deter the Fed? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. In the corporate sector, there are all kinds of variable rate debt, or as it's called, floating rate debt. For example, the mega waves of bonds that Apple issued also included a few $1 billion of floating rate notes. In a rising interest rate environment, investors like floating rate debt because the interest rises in line with short-term treasury yields. So investors make more money as rates go up, and these instruments don't lose value as rates go up, unlike fixed rate debt. But for companies, it means that their interest expenses go up, and not just by a little. And the amount of floating rate debt outstanding in the US is in the trillions of dollars. First, let's look at what interest rate increases do to interest expense for a company with floating rate debt. For example, AutoNation, the largest new and used vehicle retailer in the United States, owes $2.1 billion in floating rate debt to finance its new and used vehicle inventories. This type of debt is called floor plan. In floor plan financing, the collateral is each vehicle listed by vehicle identification number. For new vehicles, floor plan is super cheap because it's backed by superb and liquid collateral, namely new vehicles that can be sold at cost to other dealers. It's also automated, doesn't involve Wall Street bankers or fees, and is often subsidized by automakers via floor plan rebates. AutoNation's $2.1 billion in floor plan outstanding has been roughly flat for the past 3 years. The interest rate is based on 1 month dollar LIBOR plus some fixed percentage points. 1 month dollar LIBOR tracks just above the 1 month US Treasury yield. The 1 month LIBOR was 0.2% in 2015 when the Fed's zero interest rate policy was still in effect. It has now risen to 2.3%. In other words, it multiplied by a factor of 11. And here is what AutoNation's interest expense did over those years. In the third quarter of 2015, it paid $15 million in interest expense on its floor plan. In the third quarter of 2016, it paid $19 million. In the third quarter of 2017, it paid $25 million. And in Q3 2018, it paid $33 million in interest expense. In other words, on about the same amount of floor plan debt, the interest expense over the past year alone jumped by 30%. Over the past 2 years, it jumped by 80%. And from Q3 2015, the last quarter before the Fed's first rate hike in this cycle took place, interest expense jumped by 122%. And this interest expense will continue to rise. A lot of companies face the situation where the interest expense on the floating rate debt has begun to surge. And the numbers are big. Total levels of floating rate debt outstanding are hard to come by, but we can get a handle on some aspects of it, enough to give us an idea of the magnitude. There are $5.4 trillion in corporate bonds outstanding that were issued by non-financial companies, so excluding the banks. The amount has surged by 70% since 2010. According to a study by the Federal Reserve, 98% of corporate bonds carry a fixed rate interest. These bonds only become a problem when they mature, and they have to be refinanced at a higher rate. Quite a few of these bonds will mature in 2019 and more in 2020 and more in future years, and they all face higher rates than the coupon they're currently paying. So this is happening, but most of it will be happening in future years. Then there are loans. The Federal Reserve study estimates that 85% of corporate loans are floating rate loans. So that's where the action is. There are 2.2 trillion in so-called commercial and industrial loans outstanding that are held by banks in the U.S. These C&I loans, as they're called, are usually high-quality loans backed by good collateral. Then there are 1.3 trillion in so-called leveraged loans in the U.S. These are mostly held by investors in loan mutual funds, loan ETFs, and collateralized loan obligations, or CLOs. They are traded like securities. These loans have been issued by junk-rated companies with insufficient or negative cash flows. Many of these loans are issued to fund risky acquisitions by companies that are owned by private equity firms, and a good portion of these loans have been issued to fund special dividends back to the PE firms that own the borrower. These factors make leveraged loans too risky for banks to hold, and banks just arrange them and offload them to investors. The Fed has been fretting about the growing risks of leveraged loans since 2014, which only made them hotter in the eyes of investors. They've been growing rapidly, and there are now 1.3 trillion of them. Those two loan categories combined, C&I and leveraged loans, amount to 3.5 trillion. Those are the segments we have good numbers on. Then there are many other types of floating rate loans that are not included in those two categories, such as floor plan financing that I mentioned a minute ago, or receivables financing by specialty lenders and the like. And there are floating rate commercial real estate loans, which could be headed for particular trouble since the value of the collateral has been so inflated. The Fed has been specifically warning about commercial real estate lending as a threat to the financial system. But these floating rate loans are not tracked separately, and we don't know their amounts, but we know it adds up after a while. So let's put some realistic company-specific dollars to it. A leveraged loan of $1 billion might carry an interest rate of 3-month LIBOR plus 5 percentage points. Back in 2015, the total interest rate was 5.3%, and the company had $53 million a year in interest expenses on that $1 billion loan. Now the company has to pay 7.6% interest for the same loan, and the interest expense jumps to $76 million a year, so $23 million in additional interest expense. Leveraged loans are issued by companies that usually have negative cash flows, so this additional interest expense just makes their cash flow a lot worse. Credit problems always hit the riskiest, most vulnerable companies, precisely those that issue leveraged loans. The Federal Reserve, in its study, looked only at 2.2 trillion in C&I loans, 85% of which it said have a floating rate. The Fed estimated that for these loans, an increase in the federal funds rate from 1.25%, where it was in December last year, to 3%, where it will be by mid-next year, would increase interest expense by $37 billion in 2019. So that $37 billion increase is just on these C&I loans. But even at these mostly sound loans with good collateral held by the banks, the Fed study found, and I quote, "The modest vulnerability found for the aggregate non-financial corporate sector can mask more significant risks in some industries. In particular, sector with high leverage and high exposure to interest rate changes may be more sensitive to an increase in interest rates." So, in other words, the average or aggregate exposure is essentially meaningless with regards to the more vulnerable companies, and defaults happen on a company-by-company basis. This is the least risky part of the lending market, the C&I loans. At the riskier part of the lending market, leveraged loans and the like, just about all companies fall into this vulnerability basket. They have junk credit ratings, they have too much leverage and not enough cash flow, and often negative cash flow, with some companies practically begging for default. It's not Apple, Google, or any of the companies with rich cash flows and relatively little debt are at risk. At risk are companies whose cash flows are already negative before interest rates began to surge. Higher interest rates will make them more vulnerable, and many of them will head into default to sort out the debts in bankruptcy court. Investors who have been falling all over themselves chasing those leveraged loans and variable rate commercial real estate loans will find out how much of a post-default recovery there is for them. There have been warnings for a while that recoveries will be a lot lower than in prior cycles, so we'll see how that turns out. But what will the Fed do? Will the Fed back off its rate hikes because the most over-leveraged companies are suddenly at risk of default due to higher interest rates? Nope. These are precisely the excesses that the Fed has been targeting and has been mentioning in its pronunciations for over 2 years, particularly leveraged loans and commercial real estate loans. It has been warning about the risks, and the entities that carry most of the risk are investors, including many global investors. For example, Japanese investors, long ravaged by zero interest rates, have the hots for U.S. collateralized loan obligations. So Wall Street is packaging junk-rated leveraged loans into yen-denominated AA or even AAA rated CLOs, and the Fed isn't going to worry about these hapless Japanese investors getting taken to the cleaners. The Fed in general isn't worried about investors, domestic or global. It's worried about the banks in the U.S. and more broadly the U.S. financial system. C&I loans are with the banks. Those loans are in relatively good shape, except in some highly leveraged sectors. There will be plenty of defaults too, but the collateral is generally pretty good, and the big banks are capitalized enough to be able to digest those losses, though a few smaller banks might crater. The areas with the biggest risks have been taken on by investors spread around the globe, from pension funds in Norway to the lone mutual fund in your well-diversified 401k. And those are not high on the Fed's worry list. So if these defaults occur in an orderly manner, to be dealt with systematically in bankruptcy court or through debt restructuring negotiations outside of bankruptcy court, with damage mostly limited to investors, and overall credit doesn't freeze up, well, then the Fed is likely to just nod approvingly. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you've been listening to the Wolf Street Report.